Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello friends, today we are going to look at revision of chapter 7, which is securitization. Now this was chapter 6 in old syllabus, and in new syllabus this is chapter 7 in AFM. Right, now let us look at my compiler through which, theory compiler. Now in fact this is V1, and in V2 this number is in fact already become 310 or something. We have 310 questions. I will take you through more and more chapters, and you will realize that this number is much higher. I will be releasing the fully updated version of this theory compiler for AFM sometime in the next 2 to 3 months, sometime in Jan or so. By which time all the revision would be done, and at the same time more new questions would have been added, which will have all the updated questions from new topics that have added in various chapters. As of now, this 290 is already increased to 310 because of the number of questions, because of the new chapter, so on and so forth. Let us look at this chapter, securitization, and please note in this securitization chapter, there have been number of questions have been asked. The 13 questions have been asked so far. There have been 13 times questions have been asked. In what? In the last, in the old syllabus, from May 2018 till May 2023. Okay, this does not have November 23, but this has May 23. And in that, questions have been asked 13 times, 13 number of times. The number of questions that have been asked is only, I think, 7 or 8 questions. We will look at that, but it's a very important chapter. Specifically after startup financing, securitization is the next most important chapter from a theory perspective under the old syllabus. Under this new syllabus, will it remain the same? Broadly, yes, because the chapter weightage has not changed much. It is broadly in the same range. We will come to the chapter weightage when I discuss in a separate video, but it is broadly remains the same, securitization chapter weightage. So, I presume that even in the new syllabus, you will get similar kind of weightage for theory questions from this particular chapter. So, now let us look at the chapter securitization. This is chapter number 7. 1, 2, 3, 4, 5, 6, 7. And in this chapter, there are 14 questions. Out of these 14, about 4 or 5 are new. And out of these 14, 7 have been asked so far in past exams, and these 7 have been asked 13 times. So, one question may have been asked more than once, twice, or so on and so forth. So, 7 questions have been asked a total of 13 times, and this chapter under the new syllabus has total 14 questions. Okay, and this 14 questions includes new questions like about blockchain, about tokenization, risks of blockchain, risks of securitization, so on and so forth. Okay, let us go and have a look at this particular chapter. Complete revision, comprehensive, one place where you can understand everything about securitization. So, first question is define securitization and explain its important features. What is securitization? What are its important features? This has been asked in the past exam also. Have a look at it. Process of securitization typically involves creation of pool of assets from illiquid financial assets such as receivables or loans which are marketable. So, basically you think of 2 banks, HDFC, ICICI. Okay. HDFC has given a lot of auto loans to people like you and me. All these loans are combined together, made into a pool, and this pool is sold to ICICI by HDFC. So, basically HDFC has given a loan. HDFC is due some money from people like you and me, who are individual borrowers. That receivable is sold to ICICI. So, it is basically sale of receivable, sale of some kind of a current asset. Think of it very simply. Please don't go by the technical definition of a current asset. I am just telling you from a bank's perspective, assets are not look like that, but I am trying to help you understand that it's like sale of a current asset, receivable being sold by one person to another person. So, you have pooled everything. These individual loans may or may not be liquid or may not be marketable, whereas all these illiquid loans are combined together, made into a single pool, and then you sell it off to ICICI. So, HDFC is sold to ICICI. Now, what happens in this process? Money is collected by HDFC. Whenever the, you and I make repayment, we don't now make repayment to ICICI. We still make to HDFC. HDFC acts as just a collection agent and passes on the money to ICICI. Okay, in between there are other players also involved. We will discuss about that, but broadly this is the process. What are the features of securitization? Creation. So, the question is define securitization, explain features. So, first we discuss the process of securitization involves creation of pool of assets from illiquid financial assets such as receivables or loans which are marketable. Okay, the features are creation of financial instruments. So, When these assets are bunched together, a pool is created. So if you look at it here, all these auto loans are bunched together and a pool is created. Now from this pool, you can also create subsequent financial instruments. What are those? I will tell you. But initially, please understand that you can actually, from this pool, you can create separate instruments which can be sold. Securitization process can be viewed as process of creation of additional financial products or securities in market backed by collateral. So what is the collateral that you have? You can create a security out of this pool, and the security is backed by the pool, which is backed by auto loan, which has the two-wheeler or the four-wheeler or the tractor or anything, whichever is an automobile, it has that as a collateral. So the collateral primarily is this pool. Pool is backed by loans, or pool is created by loans, and the loans have security, automobiles as security. So securitization process can be viewed as a process of creation of additional financial products or securities in market backed by collaterals. Here collateral refers to this particular pool. Okay, bundling and unbundling. When all assets are combined in one pool, it's called bundling, and when these are broken into instruments of fixed denomination, it's called unbundling. So when you make all these auto loans into one pool, it is called bundling. Splitting of the entire pool of assets known as unbundling. Tools of risk management. In case assets are securitized on non-recourse basis, then securitization process acts as a risk management tool as the risk of default is shifted. So when HDFC sells this particular entire set of loans to ICICI, HDFC can either say one of the two things. First one is they can say it is non-recourse. That is, I am washing my hands. It is your responsibility. It is your headache. Okay, whatever money comes from the auto borrowers, I will pass it on to ICICI. If the money does not come, I will not pass on. That is called non-recourse. That is, ICICI does not have any recourse to HDFC in case of any problem. Whereas, the other scenario is recourse, which is, if some borrower does not pay, then HDFC has to pay ICICI. So, when HDFC pays ICICI, ICICI is not taking any risk. ICICI is not taking any risk. When you take risk, you get greater return, right? So, ICICI will, when they buy the assets from HDFC, ICICI obviously will pay smaller discount if it's a recourse kind of a transaction. If it is non-recourse, where ICICI is taking higher risk, then ICICI will say, boss, then the interest rate that is applicable or the discount that is applicable will be very large, because I don't know the actual proportion of defaults, proportion of people who are good, bad, rating. I mean, rating they will know, but I only know certain history. I do not know exactly all the borrowers like you do. So hence, I will charge a higher rate of interest or discount when I am doing a non-recourse transaction. Then, structured finance. In this process, financial instruments are tailored, structured to meet risk-return trade of profile of investor, and hence these securitized instruments are considered as the best examples of structured finance. So, what is structured finance? You are structuring some kind of a loan arrangement to meet the requirements of both the borrower and the lender. So, this structured finance is also basically financing of HDFC. See what happens, HDFC has given all the loans, but once it has given the loans, money is gone out of it. In its books, it only has loan as a item on the asset side of its balance sheet. But however, let's say HDFC needs money. What will HDFC do when it needs money? It can do a securitization whereby it can parcel all these loans, sell them to ICICI and receive the money in return. Right. So, this will serve as a instrument to create some kind of specific, customized, structured loan, or not loan, but financing arrangement so that you get money. Tranching. Portfolios of different receivables or loans or assets are split into several tranches based on risk and return they carry, called tranche. Each tranche carries a different level of risk and return. So, these particular pool, as I said, you can have interest only security or principal only security, or you can also call it, based on the rating, you can split it into tranches. So, you can have multiple tranches. Tranche means a set. So, a pool is a combined thing that is split into multiple parts. Each part can have different characteristics. So, you may have all Mumbai borrowers in one, all Chennai borrowers in one, all principal only in one, all AA rated in one, like that. You can tranche it multiple ways. Homogeneity. Under each tranche, the securities issued are homogeneous nature and even meant for small investors who can afford to invest in small amount. So, when you create a tranche, the tranche is basically again a set of all such loans. That loan can be made into individual units. So, there are 1,000 auto borrowers like you and me who borrowed from HDFC. These auto loan borrowers, 1,000 borrowers, each of us has taken, varying amounts, some 1 lakh, some 2 lakh, some 5 lakh. Total, everybody put together is some, let's say 20 crores. Now, this 20 crore money can be put together, and again it can be split into 1 lakh rupees each, which 1 lakh can again be sold to individual investors. And say, 1 lakh I am selling you give me some amount based on this 1 lakh. And whenever the money comes from you and me, people like you and me who are all borrowers, they will pass on the money to the holders of that particular instrument. So, you can basically create tranche that are of homogeneous nature. You can create tranches that are of homogeneous nature, even meant for small investors. So that way, HDFC initially takes the risk, then splits the risk among 1 lakh people, 10 lakh people, 5 lakh people by selling them small parts. Now, theoretically, regulatorily, they don't do it, but I am telling you, regulatorily, this kind of securitization transactions are currently allowed between banks and large players. They are not allowed to invest. Small retail investors are not allowed, especially for these kind of loans. However, theoretically, it is possible. In US, it is definitely possible. In US, you have all these collateralized debt obligations called CDOs. There are a variety of products like that in US where they securitize home loans and then bundle, unbundle and split the tranche and make small pieces and then sell it to retail investors also. It is not allowed, permitted in India as of yet from a bank's perspective. After having understood the meaning of the term securitization and its features, let us now actually move to the other important question, which is what is the mechanism of securitization. Once we understand this, then we can understand who are the players involved, what are the benefits, risks, so on and so forth. To understand mechanism of securitization, in the process or mechanism of securitization, the first step is creation of a pool. So, you actually have an originator or a servicer, basically the person or an entity which actually gives the loan. So, think of this as HDFC Bank, which is actually given auto loans. This HDFC Bank or any other bank which is actually given out the loans is known as the originator. They are the original lender. These guys actually then go and create an SPV. SPV is a special purpose vehicle. This special purpose vehicle, the loan or all the borrowings are actually transferred to that. Basically, the SPV is the one which is holding all these entire specialized or separated borrowings. Then, once these assets are pulled in SPV, the SPV creates something called as a security based on the underlying of all these assets or all these borrowings. So, SPV designs the instrument based on nature of interest, risk, tenure, etc. of the pool of assets. These instruments can be passed through or pay through. I will explain to you what is pass through, pay through later, but these can be any kinds of instruments. So, basically the SPV creates these particular instruments, and then there is a trustee that is appointed. A trustee is someone who is basically a third party. This SPV is also a special purpose vehicle, but it has a direct linkage. It has been created by the originator, whereas a trustee is a third party. You have Axis trustee, then you have IDBI trustee. So, there are a variety of financial institutions which provide trusteeship services. So, you approach one such financial institution and that particular trustee goes through all the documents of the SPV, goes through the loans, documents and all, but they are more procedural. They don't go into the actual details of the borrowings or the quality of borrowings. That is not the mandate of the trustee. The trustee is only with respect to the process, ownership and legality rather than about the pricing or the creditworthiness of the borrowings and so on and so forth. So, in order to check the creditworthiness or in order to check the quality of the borrowings, they also appoint somebody who is known as a rating agency. So, the rating agency in association or along with the originator, the SPV and the trustee's role is minimal, but they come and they value these assets. They come and value these assets, they go through the assets, they look at the quality, they look at the prepayments, they look at the repayment tenure, whether there are any issues, geographical concentration, so on and so forth. And then they issue or assign a rating to this particular pool of assets. Once this is done, if the rating is very good, then obviously the interest rate can be much better, or rather when you sell, the discount on sale will be lower. However, if the rating is poor, then you need to get somebody known as a credit enhancer. This credit enhancer is someone who is usually related to the originator. So, they come and say, for the first 10 crores of loss, we will bear it, or for the first 15 crores of loss, we will bear it, or they will give some kind of assurances which say that, which rather increase the quality of the overall pool, which are basically enhancing. That is why they are known as credit enhancers. And once this all thing is done, they again go back to the trustee, and the trustee puts all of this in sort of documentation and says, okay, now everything is fine, this is what we are going to do. You also of course appoint lawyers in the process to go through the documents. Then what happens is, the SPV, whenever the original borrowers pay money, they pay money to the originator, that is HDFC Bank, and HDFC Bank actually passes them on to the SPV. SPV then intimates the trustee and pays this money to the investor. Now, who is this investor? Once this trustee and SPV, originator, credit enhancer get together and finally rate a specific set of pool of assets, they now reach out to investors saying, now we have this brilliant set of or rather a great set of pool of loans that we have or assets that we have, why don't you buy it? So they reach out to investors and sell this loan to investors. Now, when the investors, they buy this based on the rating, based on the quality of the asset, so on and so forth, and they pay a discounted value of the loans or of the borrowings, whatever these borrowers have taken from the originator, they pay a discounted value. So that discount is basically the interest rate. They take some interest rate, compute the discount and pay up the money. Basically they buy the loan. Once they buy the loan, whenever interest is serviced by the borrower to the originator gives it to the SPV, and SPV passes it on to the investors. So the originator as well as the SPV are just a conduit. Conduit means medium or a pipe for subsequent payments. They are not responsible. Again, we have talked about recourse and non-recourse kind of arrangements. Keeping that aside as well, they are primarily the originator and SPV pass on all the money that they get to the investors who are now the owners of that loans, or who are now the final lenders to these borrowers. However, in this process, the originator servicer may also collect some fees. So if you now come back and look at it, administration of assets is subcontract back to the originator, which collects principal interest from underlying assets and transfer to the SPV, which works as a conduit. So basically, SPV works as a conduit for making payment to the investors. Recourse to the originator. Performance of securitized paper depends on performance of underlying assets. Securitized papers go back to originator from SPV. So if there is recourse, then obviously if some borrower doesn't pay up, then the originator has to fulfill it, or also the credit enhancer, someone who's given the guarantee, may have to fulfill it. Then repayment of funds. SPV will repay the funds in form of interest and principal that arises from assets pool. Obviously, whatever money comes to the SPV from the originator, who actually gets it from the borrowers, they pass it on to the investor. Credit rating to instruments. That is, credit rating can be done to assess the risk of the issuer before the sale of the instrument. So credit rating is obviously done before the eventual sale of this instrument happens to these investors. So this is the broad mechanism of securitization. Now, after having understood this, it makes more sense for us to understand about the next aspect, which is what are the benefits of securitization, or who are the players of securitization, who are the participants. I think this is much more important because it is directly linked. So let us look at this. And this is also an important question and a past exam question. So who are the primary participants? Originator. We just discussed about the originator. Is initiator of the deal, also called as securitizer, receives the funds generated by selling assets, correct, transfers legal as well as beneficial interest to the SPV. This is what I explained. Then who is the SPV? SPV executes the deal. It holds the legal title of assets transferred from the originator. Exactly. It holds a key position in the overall process and issues the securities called as asset-backed securities or mortgage-backed securities to investors. So they are the one who actually operate, or they are the one who do the entire mechanism or process. Now investors, these are buyers of the papers, and the money invested by them is received in the form of interest as well as principal. So whatever money EMI is received from car loan borrowers, that is split into interest and principal and passed on to the originator to the SPV to the investors. Who are the other participants? Obligers. Who are these obligers? These are the main source of the whole process. That is, these are the borrowers. They owe money to the firm and are assets in the balance sheet of the originator. Basically, you and I who take car loans from HDFC, we are the obligers. The amount due from the obliger is transferred to the SPV. Correct. The loan what we have taken from HDFC is sold by HDFC to the SPV. Rating agency. These assets must be assessed in terms of quality, credit support, as securitization is based on pool rather than originators. It assesses the following, that is the strength of the cash flow, mechanism to ensure timely repayment, credit quality, liquidity support, strength of legal framework and plays a vital role. So basically they assess how good is the credit quality, what is the credit worthiness of these entire obligers or the borrowers, and then how are they going to perform and how are they going to pay to the originator, and how is the originator going to do the SPV, and the SPV of course will pay to the investor. Then you have RPA. Who is an RPA? Receiving and paying agent, also known as service or administrator. It collects the payments due from the obliger and passes it on to the SPV. They follow up with the defaulting borrowers and if required initiate appropriate action. The originator or its affiliate acts as the servicer. So basically receiving and paying agents are usually the originators only. They do all the collection process. Then you have trustees. These are appointed to oversee all parties who acquire the securities to perform the deal in true spirit of the agreement. Then you have credit enhancers. Investors in securitized instruments require additional comfort in form of credit enhancement for credit rating of issued securities, which increase the marketability of the securities. So in order to improve the marketability of this entire illiquid pool, which is again securitized and issued in the form of securities to investors, as I said, there will be somebody who will come as a guarantor or some kind of enhancer. Credit enhancement is provided by the originator in form of over collateralization or cash collateral, third party in the form of letter of credit or surety bond. So these are the people who actually do this, enhancement of the quality of the credit. So we will take the first loss, or we will give you guarantee, or we will ensure that there is some extra for securitization of 100 crores, we will give you the entire loans of 110 crores. Balance 10 crores, of course, it comes back to them, but we will over collateralize. We will give you additional security. Then you also have something called a structurer. These are investment bankers who are the arrangers of the deal. These structures bring together originator, investor, credit enhancers, other parties to the securitization. They ensure the deal meets all regulatory, legal and tax requirements. So this is another very, very important, basically a broker who arranges for all these securitization transactions. So these are all the players who are involved in the securitization process. Now, after having understood this, let us go and look what are the benefits of securitization. Let us look at the next question. What are the benefits of securitization? This is also an important past exam question. Benefits to the originator, the one who actually originally has lent the money. They can off-balance sheet financing leads to improved liquidity position. They can basically raise money in an off-balance sheet purpose. Off-balance sheet means if you have a loan, then it is always shown on your balance sheet. But off-balance sheet means you are selling an asset that you have and getting money. So the asset that is there on your balance sheet has been moved off the balance sheet. That is what is called as off-balance sheet financing. Servicing is transferred to SPV, results in more specialization in the main business. So basically you keep giving the loan and then servicing part you give away to the SPV. Helps improve ratios, that is capital to weighted asset ratio. So this I told you. So the loans that you have given, which are appearing in balance sheet as assets, go away and you actually get cash from the investors. That is the people who buy your loans. There is reduced cost of borrowing. So securitization rates are more or less close to borrowing rates. In some cases they are lower than borrowing rates because of priority sector loans kind of a requirement. That is, other bank may desperately need the loan that you have. They will ensure that they will give a lower discount. That is, instead of asking you to pay a higher rate, they will ask you to pay a lower rate only. What are the benefits to the investor? First one is diversification of the portfolio. So somebody, let's say, has a lot of auto and does not have, let's say, housing. So they can buy, let's say this is 100 and this is 20. What they can do is they can sell some of these and then they can buy some of these. That way they can actually diversify their portfolio. Or if you don't have anything in textiles, add some textiles. What I mean by add textiles, buy loans given by HDFC to textile people, you buy them as ICICI Bank. That is what I mean by add textiles. Okay, helps to meet regulatory requirement of investment of fund in specific industry. This is what I was telling you as priority sector requirement. In case of recourse arrangement, if there is any default by any third party, originator shall make good some amount for the compensation of such loss. So in some cases, as I said, when there is recourse arrangement or where there is credit enhancement or where there are certain cases where somebody comes and gives a guarantee, you don't lose out if the original borrower or the obliger makes a default. So these are key points or rather important benefits of securitization. Next, coming after that, what are the problems faced in securitization? Now this is a very, very important question, or rather this is also again a past exam question. The problems can be highlighted as STADSF. S stands for stamp duty. Securitization requires stamp duty because you are selling an asset. Sale of asset comes under Stamp Duty Act. So you by design you are forced to pay a significant stamp duty. You don't have to pay so much stamp duty on when you make loans or borrowings. So I have done in cases where in case of securitization the stamp duty itself runs into lakhs, whereas for loans it is typically on 500 or 1000 or 2000 rupees stamp paper. Then you have taxation. Because you are selling an asset, there could be issues, there could be potential issues on asset sale, capital gains and so on and so forth. This is a very tough grey area. Then you have accounting. Because you are selling out the assets, you have to ensure that the accounting is done proper. Even though subsequently people pay you, the borrowers, auto loan borrowers pay you the money, it is not your money, you are just acting as a servicing agent. So you have to ensure that those money that is coming in is actually kept in a separate pool. Lack of standardization. Securitization transactions can be largely customized between two parties. Then inadequate debt market. We don't have a market wherein the securitized loans can also be further issued. You can create subsequent instruments, debt instruments. So what I told you, like collateralized debt obligations and so on and so forth, we don't have a market. In India, RBI doesn't allow you to create any securities out of these securitized loans. Ineffective foreclosure laws. So even though we have SARFAESI Act, in India we don't have a great foreclosure laws. That is, the process itself is a punishment. So you actually have people taking years together to close their loans, even if they are defaulting, whether it is home loan or auto loan or whatever. So that actually hinders the process of securitization, because when the investor is buying a security, if he is going to get the money after 1 year, 5 years, 10 years, there is no point. If somebody has defaulted, either it should be closed immediately or you should pay up immediately. It cannot drag on for multiple years. So these are largely the problems, especially in the Indian context with respect to securitization. Next question, what are pass-through certificates and pay-through securities? If you remember, I said this is one of the key things and explain these differences. This question has been asked more than once in the exam as well. Pass-through certificates. The securities represent direct claim of investors on all assets that have been securitized. Since all cash flows are transferred, the investors carry proportional beneficial interest in the asset held by the SPV. It should be noted that since it's a direct route, any prepayment of principal is also proportionately distributed among the securities holders. So, those are pass-through certificates. Also note that on completion of securitization by the final payment of assets, all the securities are terminated simultaneously. So, basically, once all the money is paid from all the borrowers to the SPV, it is passed on to the investors. Once the final payment is made, all the securities are terminated at the same time. Now, what are pay-through securities? Pay-through securities are different compared to pass-through certificates. There is a limitation in pass-through certificates. What is the limitation? Cash flow as it comes is passed on to the investors. Now, when there is a cash flow that is as it comes is passed on to the investor sometimes in case there are prepayments, the investor receives excess cash flows. So, what these pay-through security do is, all the money that is received from obligors is pooled and fresh securities are actually issued to the investors. So, the final units or securities that are issued to the investors are backed by the debt. What is this debt? Debt is basically the SPV issuing certain bonds or some kind of debt instruments to the investors. But how does it issue bonds? These bonds are backed by the original assets. So, whenever money comes from the original borrowers or the original auto loan borrowers, that money is actually pooled and that money is invested for short term and that money is used to service this debt. So, basically there is an in between a debt security. So, there is first original borrower, then there is SPV. The SPV has all these loans. These loans are the collateral for a debt that it issues. This debt is issued to the investor. So, whenever the loan money comes, the loan money is put, if there is surplus money, that surplus money is put in investment, and whatever money is required to service the debt, that money is taken and passed on to the investor. So, that way the investors have a clear defined specific cash flow or slightly more predictable cash flow. This permits SPV to reinvest surplus funds for short-term needs as per their requirement. Cash flows resulting from early retirement of receivables and cash will be used for short-term needs. So, if you received any prepayment money here, that can be invested temporarily and the normal debt payments can be made to the investor. So, these are pay-through securities. So, pass-through certificates and pay-through securities, please remember there is debt in between. Then, what are stripped securities? Stripped securities are highly volatile securities that are created by dividing the cash flows associated with underlying securities into two or more new securities such as interest only or principal only. So, what typically happens is EMI has two components. EMI has interest and principal. When you accumulate multiple EMIs of various borrowers, you can identify all the interest payments separately, all the principal payments separately. So, these interest payments and principal payments can be made into, again, when you securitize, you can create instruments separately for this and separately for this, and you can have different investors for this and you can have different investors for this. So, what this does is, an investor who is interested in getting themselves exposed only to the principal value, an investor who is interested in getting themselves exposed only to the interest value of the flows from the loans can actually buy the securities. Now, what also happens is, in interest rate in the market changes, let's say it increases, then the value of IO securities rises. Why does that happen? When the market interest rate is very high and you borrowed a loan, let us say you and I are normal auto loan borrowers and market interest rates have suddenly gone up and our loan is a fixed rate loan. So, we will continue to service our loan. We will continue to service our loan because we don't have any way in which we can repay the loan. If you have more money, if you have a lot of money, then anyway you will not take the borrowing. But when interest rates rise, you will not repay the loan. However, when interest rates fall, you will borrow from somewhere else and repay this loan. So, the prepayment risk is high when interest rates are lower, whereas when interest rates are high, you will continue to service the loan and you will continue to delay making the payments of the principal. That is, people will, there will not be any prepayments, people will postpone payments. People will say, I will take on for some more time, I will extend my loan, I will continue my loan at the same rate. So, that way the value of a PO security which represents the principal portion or principal value portion, those values, that particular security value falls because everybody is delaying payments, whereas interest value increases because everybody is servicing the interest. Whereas when the market interest rates fall and this is a fixed rate loan, everybody starts making early repayment. When you make early repayment, what happens is the PO security values increases because everybody is making payment. So the borrowers tend to repay the loans as they prefer to borrow fresh loans at low rate. So the value of the security increases, whereas the value of the IO falls because the interest portion is very, very minimal. Everybody is paying off principal, so the interest portion value is very less. So IO and PO operate in opposite directions, and they are very, very volatile because you are getting, when you create a IO security, you are saying that all the interest cash flows associated with this particular pool of assets, I will pay you, right? Now, if people repay more principal, then the interest value comes down. So, but you will get only same lower interest value, whatever is the interest that they are paying, you will get it, but the interest value has come down. Same way, if people are delaying all the loans, then they are not making principal payment. They are saying, oh no, we will pay after some time, we will pay, so on and so forth. Then, but they continue to service interest. So, the interest value goes up. So, this is how IOs and POs, they are very, very volatile, how they are particularly structured. Now, how are securitized instruments priced? Pricing should be acceptable to both originator as well as the investor. From an originator angle, the instruments can be priced at a rate at which originator has to incur an outflow, and if that outflow can be amortized over a period of time by investing the amount raised to securitization. Simply put, it is basically comparative cost. So, what is the opportunity cost? If I get this money, put it somewhere else and then meet my other obligations, what is the overall cost that I incur? That is what simply it is. From investor angle, the price can be determined by discounting best estimate of expected future cash flows using rate of YTM of a security or comparable security with respect to credit quality and average life. So, basically debt. Right, yield can be estimated by referring to yield curve available for marketable securities upon adjustments on account of spread points because of credit quality of securitized instruments. So, depending on the rating that is assigned to the securitized instruments, go back to the bonds chapter and remember and recollect that rating determines the coupon at which a company can raise or go for a fresh issue, assuming that the coupon and yield are same on the date of the issue, and that is what can be used by investor to price a securitization transaction also. So, this is how securitized instruments are priced. This also is a very important question and has been asked in the past exam. What are the various risks of securitization? This is a very important question. This is a new addition to the syllabus from May 24. Risk can be categorized as follows. There are three primary kinds of risk. The first one is credit risk, second one is legal risk, and third one is market risk. Market risk within itself has other sub-risks. The credit risk or counterparty risk basically is the risk that the servicer, or rather the originator, who basically is going to collect the money from the obliger, that is borrowers like you and me, and pay the money to the investor, that particular person, that is the servicer or the originator, goes bankrupt. That is credit risk or counterparty risk. Then you have legal risk. It is basically, in India, currently we do not have a robust legal framework to deal with securitization transactions, specifically of nature of selling and buying of loans. So, given this context, there could be potential disputes that could arise on the legal ownership of the pool of assets. Then you have something called as market risk. Market risk represents those risks external to the transaction and include market related factors. The first one is something called as economic risk. If there is poor macroeconomic performance or there are downturns in industries, this could lead to change in underlying asset prices. For example, transport industry is in a continuous decline may lead to downturn in usage of services of commercial vehicles, adversely impacting the cash flows of these operators, which may lead to impact on the repayments of the commercial vehicle loans. Similarly, a fall in prices of commercial vehicles may provoke, or rather may result in lenders not actually paying up the money because the prices have already fallen. Then you have something called as prepayment risk. A change in market interest rates represents a difficult situation for investors because it is a combination of prepayment risk and volatile interest rates. So, basically what happens is when interest rates come down, there is a very, very high chance of people trying to refinance the loans or repay the loans and take another loan at a much lower rate. This results in the investors actually receiving their monies ahead of schedule and may not be able to reinvest at the same yield. So, the two issues are, first you get the prepayment, and second you are not able to reinvest the money that has been prepaid at a same yield. So, that is the second risk. Then you have this interest rate risk. This is a prominent risk where the loans in the pool are based on floating rate and the investor payouts are based on fixed rate. That is, the loans are floating and the loan rates fall, whereas the investor payouts that are to be made by the SPV, if at all they are in some kind of a fixed rate format, then there is a mismatch between cash flows that come in and actually go out. Sometimes the pool cash flow, even at 100% collection efficiency, is not sufficient to meet the investors payouts. The SPV or the obliger or the servicer typically enters into interest rate swaps when they have actually floating receipts and fixed payments, and the floating receipts are expected to go down. Then coming next to something called blockchain. This is a new topic that is added in new syllabus from May 24 onwards, and this is a very, very important thing. I expect a question on blockchain and related topics in the first 2 or 3 exams itself. So, what is blockchain? Blockchain or a distributed ledger technology is a shared peer-to-peer and decentralized open network of transactions with no third-party systems. In this ledger database, every entry is permanent and it is an append-only database. Append means you can only add and cannot be changed or altered, and all the transactions are irreversible. So once you make an entry, it cannot be changed. The decentralized network refers to a network which is not controlled by anybody. There is no single owner. Everybody has the database, everybody has access to it, and everybody can make changes. However, a change made by one person gets reflected everywhere else. The blockchain creates a decentralized distribution chain that gives everyone access to the ledger at the same time. No one is locked out awaiting changes but from another party, while all modifications of the ledger are recorded in real time, making changes completely transparent. One can look at the following example of a blockchain. A transaction like sending money is initiated. A transaction is broadcast via the network to everybody. The network validates the transaction using cryptography, and the transaction is represented online as a block. The block is added to existing blockchain and the transaction is complete. So basically you have everything as blocks. Each individual transaction is a block, and that block can't be deleted. It is irreversible. Once a transaction or an entry is made, it is completely irreversible. Then what are applications of blockchain? This is another important question. Falling under the use of blockchain across variety of industries. First one, financial services. Blockchain can be used to provide automated trade lifecycle in terms of transaction log or any transaction of asset or property, whether physical or digital, such as laptops, smartphones, automobile, real estate, from one person to another. So financial transactions, when done through blockchain, are recorded and they provide an authenticated log. In addition, they are irreversible and the data is available to everybody. These transactions can be for anything, right from automobiles, real estate, laptops, smartphone, or any such product. Healthcare. There can be secure sharing of data by increasing the privacy, security, and interoperability of data between doctors, patients, and service providers by eliminating the interference of third parties and avoiding overhead costs. So with respect to even healthcare, where the confidential or rather personal data is required to be shared between a doctor and a patient, and however we also are required to go through third parties like diagnostic services and so on and so forth, all the data can be hosted on a blockchain and only authenticated people can actually have access, and the data is completely stored, is available for everyone to check, whoever is part of that particular blockchain. Then you have government. In government, blockchain improves transparency and provides a better way to monitor and audit transactions in land registration, vehicle registration, and management, along with e-voting systems. So theoretically, there is a concept that all of us could one day cast our votes by e-votes rather than going to any specific polling booth. What a wonderful idea. Then you have in travel industry, blockchain can be applied in money transactions and in storing documents like passports, ID cards, reservations, and managing travel insurance, loyalty, and rewards. So you can store information that is personal to you, that is private to you, but at the same time is authenticated by an agency and is visible to all the people who are authorized to view it. Finally, economic forecast. Blockchain makes possible the financial and economic forecast based on decentralized prediction markets, decentralized voting and stock trading, thus enabling organizations to plan and shape their businesses better. So using blockchain, one can also make economic forecasts when you have access to a lot of data where people give their votes, people give their thoughts, people give their expectations, so on and so forth. So again, this is slightly far-fetched, but this is one of the potential uses of blockchain. Then coming to what are the risks of blockchain? This is also a very, very important question. Members of a particular blockchain may have different risk appetite and different risk tolerances. It may lead to conflict when monitoring controls are designed. There may be question about who is responsible for managing risk if no party is in charge, and how proper accountability is to be achieved in a blockchain. So the idea here is in case of a blockchain where everyone is an owner and nobody is an owner. Think of a WhatsApp group where everybody is an admin. If everybody is an admin, nobody is basically the admin. So similarly in a blockchain, when you have too many people who are owning up and no single one person actually being in charge, there could be differences with respect to the controls that are set up and the systems that are set up. Similarly, the reliability of financial transactions depend on the underlying technology, and this underlying consensus mechanism has been tampered with. It could render the financial information stored in the ledger to be inaccurate and unreliable. So the blockchain and the basic underlying technology or mechanism is tampered, then the whole blockchain is not really useful. Then in the absence of central authority to administer and enforce protocol amendments, there could be challenges in development and maintenance. Yes, because there is no one person. How will you develop? How will you make new changes? Why will somebody have even the incentive to make new changes? And even if you make such changes, you may make it very, very complicated, with others may agree or may not agree. Finally, as blockchain involves humongous data getting updated frequently, risk related to overload of information. Absolutely. There could be information overload, could potentially challenge the level of monitoring. Further, to find competent people to design and perform effective monitoring controls may also prove to be difficult. That is, when you have such a vast, large, humongous system where a lot of transactions are getting added every day, getting right kind of people to design and monitor the entire system may prove to be very difficult. What is tokenization and what is its relationship or rather similarity with securitization. Tokenization is a process of converting tangible and intangible assets into blockchain tokens. Digitally representing anything has recently acquired a lot of traction. It can be effective in conventional industries like real estate, artwork. So, I'm not sure if you've heard of this, there is something called as NFT, non-fungible token. People started designing some works of art on their computers or on their mobiles and started selling them. There were some cases where somebody designed a cat or a mouse or a character and they started selling them and saying that they own the intellectual property rights. So that very, very broadly is a token. A token represents the right over a tangible or an intangible asset. Since tokenization of illiquid asset attempts to convert illiquid assets into product that is liquid and tradable, to a certain extent it is similar to our concept of securitization. So tokenization and securitization broadly, they have some similarities. What are the similarities? First is liquidity. First and foremost, both securitization and tokenization inject liquidity into the market for assets for which are otherwise illiquid. So things like art or real estate or others which are not necessarily, which cannot be traded normally, right, or which have an illiquid market. The tokenization attempts to inject liquidity, which is very, very similar to securitization. Diversification. Both help investors to diversify their portfolios, thus managing risk. That is also a very fair point. Then trading. Both are tradable and help generate wealth. New opportunities. Both provide opportunities for financial institutions and related agencies to earn income through collection of fees. So banks, in addition to earning interest income when they act as servicer or as originator, they also get some fees because they are actually collecting the money from the obliger and passing it on to the investors. So such kind of new opportunities exist for people who are involved in this entire process of either securitization, very, very similar to tokenization. Then coming finally, the last question, this again is an important question. What is the process of securitization, or rather what is the experience of India with respect to securitization? Explain securitization in India. So Citibank has been the pioneer for securitization in India. However, after Citibank, the several other banks like ICICI, HDFC, NHB, they have caught up and now they actually control the market. The market is a huge market, and initially they all started with auto loans. However, slowly you had NBFCs also coming in, and you then started getting all these tractor loans, then auto loans, and several other commercial mortgages that started getting in, including even microfinance that started getting actually securitized parcel and then being sold out. In order to create securitization, government has come out with the SARFAESI Act, which you would have been aware of, which is to tackle the menace of non-performing assets without approaching the court. So the government has actually come out with this act, post which the banks and NBFCs are actually creating, or rather securitizing, non-performing assets and then disposing of them off to asset reconstruction companies. Finally, as per CRISIL, which is one of the rating agencies and which tracks the entire securitization sector very, very closely, in India they touched a high of approximately 1.9 trillion, that is approximately $26 billion just before the pandemic. So it represents a 5x growth in the securitization over the previous 10 years. And SEBI has also allowed FPIs, that is foreign portfolio investors, to invest in securitized debt of unlisted companies up to a certain limit. So unlisted companies who have debt could potentially be securitized, and in which FPIs can also invest. This will increase the liquidity and also improve the access for money to unlisted companies, of course, to a certain limit. So this is broadly the experience of securitization in India. So this chapter has 14 questions and all of them are very important. If you actually look at this particular chapter is next only to the startup financing chapter in the number of questions that have been asked. 13 questions have been asked, 13 times questions have been asked, but only 7 questions have been asked. So basically some questions have been, or rather most of the questions have been asked at least twice. And now you have additional 4 or 5 questions that have actually come up because of introduction of new syllabus, where they talked about blockchain, risks to securitization, tokenization, problems with respect to blockchain, so on and so forth. So my dear friends, this is a very, very important chapter from theory perspective in the new syllabus. They could potentially ask you questions either in MCQ format or proper theory format as well. So my suggestion, please go through this chapter thoroughly before you attend your exams. So all the very best, and subsequent videos will cover other chapters. Please note this entire compiler along with key questions, then important questions, everything is available as a link in the description below. So please don't forget to click that and check out the entire compiler, which is available free of cost for everyone. And of course, you can always visit our website to download our formula sheet, download our compilers, and now access our theory notes. So all the very best.